If you are new to triple net investing, it can feel like there's 1,000 options out there with no clear way to analyze them and compare them. One listing looks safe because it's a big brand name. Another listing looks attractive because the cap rate is higher. And most investors wind up just guessing. Today, I'm going to give you the simple way to compare the most common triple net type of assets so you can choose what fits your goals and avoid buying the wrong property with risk. Hi, my name is Renee Nelson, and I'm a CCIM and commercial real estate broker, and I help people buy triple net properties. I also own triple net properties myself, so I understand why people want these. They want simplicity, more predictable income, and fewer day-to-day decisions. So let's get started with a quick reset on what you are actually buying. In a triple net lease, the tenant typically pays the property taxes, the insurance, and the maintenance and repair. You're buying a stream of rent backed by the lease and attached to a real estate location that you own. That sounds simple, but not every tenant and not every lease and not every location behaves the same. So here's the framework for today. I'm going to walk you through 5 common triple net property types that investors buy all the time. I'll tell you why people like them, what the hidden risks tend to be, and how to compare them side by side. So the 5 types that we are going to look at today is a discount retailer using Dollar General as a familiar example, and a specialty retail using Sherwin-Williams as a familiar example, and medical and dental using Aspen Dental as a familiar example, and for a convenience retailer using 7-Eleven because that's familiar for most of us, and then for automotive services using a national oil change concept like Take 5 Oil Change, again because it's familiar. Important note, I am not saying any specific location is good or bad. Every deal is done by a deal decision. This is about category and how to screen them quickly. Now, before we compare asset types, you need one comparison tool. I call it the 5-question screen. And the 5 questions apply to every triple net property you will ever look at. Question 1, how much lease term is left and what are the options to renew? Question 2, how durable is the tenant's business at this specific location? Question 3, how strong is the real estate if the tenant ever leaves? Meaning, what's your plan B if they move out? Question 4, what's my exit plan and who is my buyer when I sell? And question 5, does the price match the risk? Meaning, does the cap rate make sense for the lease timeline and the market? Okay, asset number 1, a discount retailer, Dollar General. Why do investors like it? It's a simple operating model. It serves everyday needs in many communities, and it's a widely recognized format, and it can feel straightforward to understand. Here's where the risk shows up. Lease term matters a lot, and as the lease gets shorter, the cap rate usually moves higher because of the market price in uncertainty. Liquidity can vary by location. Some markets have more buyers than others. Plan B can be very market dependent because you're typically left with a retail box if the tenant moves out. So here's how to screen it quickly. Start with the lease term. Then ask, if I hold this for 3 to 5 years, what does the remaining term look like when I sell? And if you buy midterm of the lease and hold it too long, you can wind up selling it into an expiration event. Asset 2, this is a specialty retail type, Sherwin-Williams type store. Here's why investors like it. They can be smaller size stores, and sometimes they set on strong retail corridors. These can be sticky because contractors and consumers value convenience, and the store footprint can be adaptable. Here's where the risk shows up. Some leases can be shorter than what you see in the bigger box retail stores like Dollar General. Some formats and locations vary, so you need to understand the site and the access. And like all retail, if the tenant leaves, your outcome depends on the local demand for that size of building and that corridor. Here's how to screen it quickly. Look at the lease terms and options. Then look at the real estate. Is this location in a corridor where other tenants would want to be? If your plan B is is strong, your downside risk is often minimized. Asset type number 3, medical and dental. So this is like an Aspen dental clinic. Why investors like it? Medical use can often feel durable because people need care in every market. The build out can be meaningful, which can make a tenant more invested in staying when it's lease medical. These locations can be in high traffic nodes where there are other services. Here's where the risk shows up. Tenant quality matters, and not all medical leases are the same. Sometimes the lease is with an operating entity, not a large corporate guarantee. So you want to understand who backs the lease. Is it corporately guaranteed? Is it a franchisee owner who is guaranteeing the lease, or is there any guarantee at all? Plan B can be more complicated because a dental build out is specialized. Yes, it can be released, but you may need time and improvements for a new tenant. So here's how to screen it quickly. Ask who's actually on the lease, what's the lease structure, and then ask yourself, what would this space be if it was not dental? If it's in a strong retail node, that really helps. Asset 4 is a convenience type retail 7-Eleven store. Why investors like it? Convenience stores can be high traffic and location can be everything. When the site is strong, the real estate can be very valuable, often with corner locations or what we call hard corners, where it's a stoplight and a stoplight or a stop sign and easy in and out, easy access. That strong access will allow more people to come to it. That's really important. Now, here's where the risk shows up. Operators vary. Fuel versus no fuel, traffic patterns, competition, and local regulations. Lease structures can vary, and some deals have different rent bumps or rent increases and terms. And environmental considerations matter more in this type of category because fuel and underground tanks depending on the property. So here's how to screen a 7-Eleven quickly. First, understand the site, the access, the corner influence, and the traffic. Second, look at the lease term and the options. Third, ask about any environmental reporting that is available, especially if it has fuel sites or gas pumps. Asset type 5, automotive service, oil change concepts like Take 5 oil change. Why investors like them? These types of service-based users can be less vulnerable to retail shifts. The real estate is often in visible corridors with good access. Lease structure can be attractive and the user can be resilient because people keep cars longer in many cycles. Here's where the risk shows up. Brand and operator quality matters and lease structure matters. Some of these are newer concepts in many markets, so store history can be shorter. Plan B is usually better than you think because the real estate often can be reused by other automotive or service tenants, but you still need to verify the corridor demand. Here's how to screen it. Start with the lease term and the options, then look at the corridor quality and the real estate adaptability. Ask if the tenant left, what other service users would want this site. Now, how do you compare all 5 categories without drowning in details? Use these 3 comparison buckets. Bucket number 1 is lease and timeline. How much time are you buying and what happens at the expiration? Bucket 2, it's the real estate quality and plan B. If the tenant left and the site is valuable and flexible, who would be the next tenant to go in? And bucket 3 is the exit liquidity. Who buys this asset and how easy is it to sell when your hold period ends? Here's a simple scoring approach you can do in minutes. Give each deal a score from 1 to 5 in each bucket. 1 means weak, 5 means strong. Do you need perfection? No, you need consistency. So as an example, if a deal has 12 years left on a lease, it might score a 5 on the timeline. If it has 4 years on the lease, it might only score a 2 on the timeline. If the real estate is on a hard corner with strong access, it might score a 5 on plan B because remember, plan B is the tenant moves out. Who are you going to put into it? If it's in a thin location or a limited market with limited alternative users, it might only score a 2. If the buyer pool is deep and the asset type is in demand, liquidity might score 4 or 5. If it's in a niche deal in a thin market, liquidity might score 2 or 3. This is how you stop guessing and and start comparing. Now, what should you choose? It depends on what you want most. If you want maximum simplicity, you usually want longer lease terms, strong real estate, and deep liquidity. That often means you accept a lower cap rate because you're paying for the certainty. If you want higher yields, you must choose a shorter term or thinner markets, but you'll need a clear plan B for your next exit. And here's a key point. There is no free return. Higher cap rates almost always come with something you're taking on, either a shorter term, a thinner market, higher complexity, or more operational vulnerability. Your job is to choose the risk you're comfortable with, not pretend they are not there. If you want help applying this to real deals, I created a guide called How to Buy a Triple Net Property. If you're watching on YouTube, it's linked in the description. If you're listening on a podcast, you can request it by going to my website at eugene-commercial.com, download the PDF, review it, and then send me a quick email and let's schedule a free 15-minute discovery call. We'll walk through your goals and I can help you compare a few real opportunities side by side so you actually know what fits and what works. Triple net investing is not about finding the perfect tenant. It's about matching the lease timeline, the real estate, and the exit plan to your goals. When you do that, you buy with confidence and you sleep better. If this was helpful, please hit the subscribe button and hit the thumbs up. It helps the algorithm share this with other investors. Thanks for watching, and we'll see you in the next one.